I find it so strange that the moment you graduate, you're just expected to understand this entire world of personal finance that no one ever told you how to navigate. You should get a credit card, you should be saving up for a mortgage, you should be investing. Okay, but like, how do I do these things? It is such a confusing world. Trust me, I know I was exactly the same when I graduated from uni a year ago. But since then, I've read literally every single book I could find on the topic of personal finance. I watched every single YouTube video that's available out there. And so in this video, I'm going to show you the 10 things that I've done to get my financial life together, as well as introduce you to every topic and theme. Heads up, this is going to be a very long video, so timestamps are going to be at the bottom of the video and in the description box below, and let's get started. If you're completely new to personal finance and earning your own money and spending it, I think budgets can be a really great place to start to kind of help you navigate your finances and your spending. My favorite budget, and the budget I've probably heard the most positive things about, is the 50-30-20 budget. It was introduced to me by Mrs. Dow Jones. Essentially, the budget works like this. 50% goes towards your needs, such as food, rent, fuel, all those kinds of expenses. 30% goes towards your wants, so things you want to buy, clothes, getting your hair done, those kinds of things. And the final 20% goes towards saving towards your futures. That can be anything from, saving for a mortgage or investing your money into funds or stocks or something like that. Personally, I don't use strict budgets anymore. I used to. The reason is simply that I've learned a lot of things throughout using budgets that I now take with me into my everyday. So I know for me how much I should be saving on a regular basis based on my income, and I say that every month. I know how much I should be spending on myself, and I know that I should not go above that limit. And so I kind of have a system, but it's not a strict budget like this one that I follow. But I think if you're not at the point where you're comfortable with knowing exactly what goes where, how much you should be spending, how much you should be saving, a budget like this can be really useful. So after you've got your budget set up, or you know pretty much how much you want to spend in each different bucket of your expenses, the next thing you want to do is start saving for your emergency fund. An emergency fund is also sometimes called a rainy day fund, and it's essentially an account where you save up for a rainy day.
In case of emergency only.
When you're an adult and you're earning your own money and you're, having your own financial life, things may come up that you don't expect that you have to deal with suddenly, and they can cost big sums. So an emergency fund or a rainy day fund is there to help you out in those situations, and it's basically a pot of money that you set aside in a high yield savings account that can help you in those kinds of situations to pay that sum of money. If you have no money saved up in the bank, or you don't already have one, it's the first thing that you should be saving up for, at least according to literally every source I read online and in books. And what you do to start it is that you open a high yield savings account either with your bank. I know Barclays have a good rainy day savings account with like 5% interest. Lloyd's has a good one as well. You open that account and then you set up a direct debit from your account to that account. So money is being pulled out of your bank account every single month into that account. And the goal is you want to have enough to cover 3 months of set expenses in that rainy day account. The next thing that I think no one ever teaches you, and you're just like expected to know about when you enter this financial world, is credit. And there is so much stuff around the topic of credit that's just floating around, and you're just expected to know all of it. It's really confusing. So let me take you through it. Well, according to Lloyd's, credit makes it possible for you to borrow money now and repay it over a period of time. So essentially, you're using someone else's money to pay for something that you want to buy. And examples of credit can be buy now, pay later schemes. They can be credit cards. They can be mortgages, and they can be car loans. There's so many types, and it can be really difficult to get your head around what is actually credit because there's so many different types of it. Another important thing about credit that no one ever told me, and I seriously wish they did, is that everyone has a credit score. Whether you've never taken out credit or whether you've had credit, everyone has a credit score that's affected by a lot of things, and that score will affect several things as well, including whether you can rent a flat, whether you can buy a house, whether you can take out a credit card loan. A lot of things are affected by credit, so it is really important that you take care of your credit score, keep track of it, and make sure that it's good. And in general, there's a few things you can do to make sure that credit score is good. You can always pay back credit, pay it back in full, always on time. You can set up direct debits to companies like your phone bill, like your gas bill, your Wi-Fi, and you can also sign up to the electoral roll, stuff like that. Now, since we've covered credit, the only natural thing to continue with is credit cards. Credit cards is essentially a way to use credit, aka other people's money, to help you buy stuff.
How would you like to pay?
Credit card.
I want to emphasize that credit cards are great, but they are not for everyone. If you have difficulty controlling how much you spend, if you typically overspend, then credit cards may not be for you because they can hurt you more than they can help you. But if you're considering getting one, there are a lot of benefits to credit cards that can be quite useful. The first one is perks. It's the thing that people always talk about, like free miles or, restaurant credits or delivery credits or all these kinds of things. The second one is that it helps build your credit score because you're showing the bank how you're on time, always paying back your payments, you know, you're a good lender. You also often get travel insurance if you pay for your travel through your credit card. And credit card companies also often have very good policies towards if an item that you bought with the credit card is broken, if it's damaged, if it didn't come through in shipping. Because you're using their money and not yours, they have really flexible policies towards if something goes wrong with that item that you bought. Benefits obviously differ based on which credit card you have, but those were the general benefits. And now let's go over to the disadvantages. Most importantly, credit cards can have absolutely absurd interest rates. If you buy something on your credit card and you wait like 3 months to pay it back, you might end up spending double what you paid for the item because of the interest rates. And if you don't pay back your credit card in full on time, it can also affect your credit score, which we talked about can affect so many things like your ability to rent, your ability to loan, your ability to get other cards, etc. So because of these disadvantages, there's a few rules that I follow to allow myself every month to keep using my credit cards. Firstly, I use my credit card for all my everyday expenses that I would have just paid with my debit card, you know, anyway. I also pay for those one-off, more expensive purchases, but only if I have enough money in my bank account right now to be able to pay for that in debit. So in this next part of the video, we're going to be talking more about savings and investments, but before we dig into that, I want to tell you about this principle that has helped me a lot in the past year to be able to save and invest. It is the principle of paying yourself first. Essentially what that means is when you get your salary, I get mine at the beginning of every month. The first thing you do after you get your salary and you pay your like set expenses, like your rent and your bills and whatever, is that you pay yourself. When you've done the first thing we talked about in this video, which is setting your budget and finding out how much you want to place of your money in each different bucket of your expenses, when you've found out how much you want to save and invest every single month based on your goals, you set off a direct debit from your account to each of those different accounts where your savings goes into to make sure that you actually do those savings. It can be really difficult to save when you're going through an entire month spending money, you see you have a lot of money in your bank account, and at the end of the month you're like, shit, I need to save. Where should that money be going from? But if you pay yourself first and you pay off that money, you set it aside at the very beginning of the month, right when you got your salary, you don't have to think about that later in the month, and that's already sorted out for you. Now with that being said, let's talk about one of the most popular ways of saving and investing here in the UK, which is having an ISA. Now an ISA account is essentially a tax-free savings account here in the UK that allows you to save up to £20,000 each year, and the returns you make on that money is tax-free. There's a few different limitations on ISA accounts in general, as well as each different ISA account there is, but I'll walk you quickly through each one and you can kind of read up on it more if you're interested in opening one. The first type of ISA is a cash ISA, and this resembles a normal savings account a lot because you earn returns on the money you put into that account, but the returns are tax-free. The second type of ISA is a stocks and shares ISA, and it allows you to invest your money into stocks and shares essentially, and earn tax-free returns on those yields that those funds and stocks will give you, potentially. And thirdly, another really popular one is the lifetime ISA or LISA. This ISA is meant to help you save up for your first home or for retirement because the government will pay you back 25% of what you save, up to £4,000. So essentially, if you save £4,000, the government will give you £1,000 for free, like basically free money, right? And I got a lot of questions when I did my how I'm saving up for a mortgage short video about why I'm not using an ISA. And to be honest, the LISA is really great. I think it's great for a lot of people. However, currently, if you live in London and you want to be able to buy something bigger than like a studio in London, it's not the easiest thing to use. There's a cap on how much you can spend on your first home with a LISA, and that cap is £450,000. And yes, of course, there are homes in London that are less than £450,000, but for a two-bed, with rising inflation in zone 1, zone 2, even zone 3, that's not the easiest thing to come by. So I've decided I'm not going to do the LISA and I'm going to do other types of saving for my mortgage instead, which we'll talk about later, but that's my reasoning for that. So those were the 3 most popular ISA accounts. Now let's move over to investments, which is one of my favorite things to talk about. Before we get into this portion of the video, I do want to preface that I'm not a financial advisor. Always read up on the things you're putting your money into. The stuff that I'm telling you today is stuff that I've been told through other people, either banks, either YouTube videos, either books that I've read. It's the knowledge that has passed through me and that I'm now telling you, but I'm not going to say which funds that I invest in or which stocks that I invest in, but I'm going to share a little bit more about how I think about it and what I've gotten through the different things that I've learned. So first of all, what is an investment? Investing is one of the many ways that you can grow your money. Think of if you put your money into a bank account and it has a high interest rate, you grow your money through saving it in that bank account. If you invest your money into stocks and shares, it's another way you could potentially grow your money. However, there's also the opportunity or possibility that that money can decrease and that it can stagnate and that it can grow. So just keep that in mind as you think about investing. When you invest your money, you're either putting it into a stock that's a little small share of a company, or you're putting it into a fund, like an index fund, that's basically a compilation of a lot of different stocks, which again is small parts of companies, if that makes sense. So the fund S&P 500, for example, is just 500 companies. So you're basically investing when you're buying that fund into all those 500 companies. When it comes to investing, there's different things that have different risks. For example, a stock is much more risky than a fund because a stock is just one stock, and if that company goes bust, all your money goes with it. However, if you invest in 500 companies in one fund, obviously the risk of that fund dropping and going bust is very, very low because that's 500 different companies you're investing in. Personally, I only invest in index funds. There's a couple of reasons for this, but essentially index funds are really great for long-term saving, which is what I am using investments for. Finally, one more thing I want to mention is that investments are very long-term. Sure, investments can grow really rapidly throughout a year, but in general, the market is a bit up and down, and slowly it may go up, but you might be really unlucky and hit a high and then it goes down. So a nice rule of thumb that I learned actually by my bank when I started investing is that you should be leaving your money for at least 5 years before seeing any type of returns or expecting any type of returns. So if you need your money back or your money to grow in less than 5 years, then an investment might not be the best strategy for you. However, if your saving goal is more than 5 years into the future, it might be a good strategy. For example, if you want to buy a house in 10 years or if you want to save for retirement, investments can be a really good strategy for that. If you're thinking about investing, the easiest thing to do is just open a stocks and shares ISA. You can do that with your bank. You can do that with Vanguard. It's another platform you can use. If you're in your early 20s like me, you don't need more than £20,000 to invest anyways. That's a great place to start. And once you have that account open, you select the different funds that you'd like to invest in. There's a lot on the different platforms. I would definitely suggest reading up on every single one, seeing the historical data, read up into the different categories that you want to support, do your research. And once you've decided your portfolio and how much money you want to put into each fund, you set up by direct debit from your bank account to that platform, and then you're done. Now, when it comes to investing, there's one strategy that I've taken from all the books and papers and videos that I watched and learned and read, and it's dollar cost averaging. Dollar cost averaging is essentially a way of minimizing risk. As I mentioned earlier, if you look at the market performance of a fund or a stock throughout the past year, it'll often look a bit like a roller coaster. We can define that graph that looks like a roller coaster as the market, and the market is notoriously difficult to predict. People have full-time jobs trying to predict the market. Dollar cost averaging kind of takes into account that it's almost impossible to beat the market, aka knowing when the price of your fund is going to be low, knowing when it's going to be high, and earning the best possible returns on that. So instead, you invest a set amount of money every single month regardless of the price, and this strategy maximizes your chances of getting the best possible price for your fund over time. And how do you do that, you might ask? Well, we talked about it earlier. You just set up a direct debit. That might be once a month, that might be twice a month, but the general idea is just you spread out your money instead of putting a big lump sum once and then kind of hoping that that was the best time to put your money on. Another part of saving for the future can be mortgage savings. Other than the lifetime ISA, there's no specific accounts that help you save for a mortgage here in the UK. You kind of just pick and choose the different ones you want based on your flexibility, based on your time frame, you want to buy a house or a flat. I've recently started saving for mortgage myself, and some of the things that I was told at the beginning was get an overview. Have a think about what your current salary is and how much that is predicted to be over the next couple of years. If you're planning on buying with someone else, then also maybe calculate what their current salary is and how much that's going to grow. And once you have all that written down, go ahead and log into one of those online mortgage accounts. The Barclays one's quite nice. I've used that a couple of times, and you just plot in all the numbers you have written down. The numbers you get out are going to tell you a little bit more about how much you can potentially loan for and buy for, and if that number is a little bit less than what you may have expected, then it may mean that you have to save up a little bit more to be able to buy what you actually want. Although doing this kind of calculation may result in you seeing that your goal of buying a house is further away than you thought, it can also help you, guide your decisions towards the future. Maybe you should be saving a little bit more, maybe you should investing a little bit more, seeing where you're at, orienting yourself, and finding out, what your next step should be. And then when it comes to actually putting money aside into, a mortgage savings, there's a lot of options you can choose from. There's cash ISAs, there's high yield savings accounts. You might also want to put it into stocks and shares ISA. I've heard of a couple of people doing that, earning the returns and then, using some of those returns to pay for a mortgage. Tons of options out there. Look into it, see what works better for you in your time frame. And then finally, another way of saving up for a mortgage, and just another way of saving in general, is bonds. Bonds is the most recent things that I've learned about and added to my savings portfolio. Essentially, saving money into a bond means you're putting your money away for a set period of time for a set fixed rate of return. And often those returns you get can be higher than a typical savings account because you're basically not allowed to touch your money for a set period of time. So bonds can be a really great way to save, especially if you know you're not going to need that money for a set period of time. However, if you have money laying around, but you may potentially need that in 6 months, 7 months, a year, or you don't have a full rainy day fund set up yet, or you don't have extra cash just laying around in case something happens, a bond may not be for you because that money is locked away. You cannot touch it for the duration you signed up to. That being said, bonds can be a really great way of having that steady increase, that steady rate of return, especially if you have some saving goals that are closer in time and you want that money, to be back in 6 months, 1 year, 2 years, etc. Whew, that might have been the longest video that I ever recorded on this channel. I hope you enjoyed and I hope you learned some new things. Please feel free to leave any comments, any questions in the comment section below and I'll go ahead and answer them. Also let me know if you want me to dig deeper into any of these topics for another YouTube video and I'll see you soon. Bye!